Mullen Automotive just closed out the week below a psychological breaking point, under 10 cents a share. And while the number might seem symbolic, the implications are real. This isn't just a minor drop. It's a confirmation of collapse, and a flashing red warning sign for what lies ahead. MULN fell below 10 cents, ending the week in the 9 cents range. That represents a drop of over 60% in just the past 2 weeks, and more than 99% off its highs. But what's driving it? There's no fresh positive news. No deliveries. No big orders. No earnings surprise. Instead, the sell-off is being fueled by a complete lack of confidence, made worse by rebranding games, delisting threats, and the cloud of dilution hanging over every shareholder's head. Earlier this week, Mullen announced it would be changing its name to Bollinger Innovations, a clear move to distance the company from the damaged Mullen brand. And now, they've stated they intend to change their ticker symbol before August 15th. At first glance, that might sound routine. But the timing tells a much deeper story. Back in February, Mullen was notified by Nasdaq that it had failed to maintain the required $35 million market capitalization for 30 consecutive trading days. That triggered a delisting countdown, with a deadline set for August 26th. To remain listed, Mullen must maintain a market cap above $35 million for 10 straight trading days before that date. So why is the company changing its ticker right before that 10-day window begins? Because it looks like they're trying to game the system. By changing the ticker, they're trying to manufacture a temporary volume surge. A fresh ticker can confuse algorithmic traders, trigger speculative retail interest, and briefly inflate trading metrics. Pair that with a reverse stock split, and they just might push the price and market cap high enough to tick the compliance boxes, but only temporarily. This isn't about long-term shareholder value. It's about buying time. And speaking of that reverse split, don't forget the Form 14A filing submitted on July 8th. Mullen is asking shareholders to approve a reverse split anywhere from 142 to 14100, along with permission to issue millions more shares tied to over $15 million in convertible notes and warrants. That's massive dilution. And the company is barely even pretending otherwise. It's more debt, more dilution, more downward pressure. Then there's Esousa Group Holdings. On July 10th, they disclosed a significant stake in Mullen through a Form 13G per filing. Esousa is a known player in the world of toxic financing, short-term loans, convertible debt deals, and death spirals. If they're involved, it's not to hold long-term. It's to flip. Fast. So, zoom out. The stock is under 10 cents. Market cap is well below the $35 million minimum. The company is changing its name and ticker. They're proposing a massive reverse split and dilution deal. Toxic financing continues to flow in. And earlier this month, their investor relations and financials were mysteriously removed from their website, only to be gradually restored after backlash. That's not a turnaround story. That's a company trying to survive by sleight of hand. And all of this is happening while the SEC stays completely silent. There's been no intervention, no updated compliance statement, and no investigation into the endless dilution, reverse splits, and share destruction. Retail investors are left holding the bag, again. Where is the oversight? Where is the accountability? And how many more tricks will this company try before the clock runs out? Here's the math. With the share price at around 9 cents, and a float in the hundreds of millions, Mullen's market cap is estimated to be around $20 to $25 million, well short of Nasdaq's $35 million minimum. To regain compliance, they'd need to execute a reverse split to lift the share price, then hope the new Bollinger name and ticker symbol generate just enough momentum to float above that threshold for 10 trading days straight. It's a long shot. And it's transparent. The market sees what's going on. That's why the stock initially spiked on the name change, then gave it all back, and more. If Mullen's management really believed in the company's future, they wouldn't need these gimmicks. They'd be delivering vehicles. They'd be announcing contracts. They'd be focused on revenue, not reputation laundering. Instead, we're watching a familiar script: reverse split, new ticker, pump the news, dump the shares, and retail gets wrecked. This company already carried out multiple reverse splits, with a cumulative ratio of 1:422,500 over the past 2 years. And here we are again. The delisting risk isn't just real, it's escalating. The August 26 deadline is looming, and this latest plunge under 10 cents only makes recovery less likely. If they can't lift and maintain their market cap, Nasdaq will delist them, and the stock will move to the OTC market, where liquidity dries up and investor protections weaken even further. Mullen, or now Bollinger Innovations, isn't just out of time. It's out of trust. Investors have every reason to be skeptical. The fundamentals haven't improved. The leadership hasn't changed. And the game plan, if you can call it that, is just more of the same. Don't let a new name fool you. Don't let a temporary ticker bounce distract you. Because no matter what it's called on the trading screen, it's still Mullen.